Deborah Uroda for It's Your Money, and I'm in the studio with Michelle Coy of Tafoya Barrett and Associates. And today we're going to talk about rental properties and your taxes, because there are tax implications of owning rental property. So to start with, is rental income really considered a taxable income?
It is.
And why is that?
Well, you are taking in cash or taking in income for the use of the property. So that is considered income. However, you do get deductions against that. So you can deduct things like repairs and maintenance, cleaning, even travel, management fees, banking, real estate taxes.
Well, is it possible to make money on a rental property without having to stand on your head?
It absolutely is. As far as for cash flow, if you own the rental property without a mortgage, you're much more likely to cash flow and actually receive, have a net positive at the end of the month. Another way is just to build equity in the property and over time, and either pay that mortgage off or have when the property appreciates and you sell the property, you capture that.
And if I had some rental property, can I use it personally sometimes? Say I am building a house and getting it remodeled, and I have 6 months and I need a place to live. Can I use it for that, or is that a no-no?
You can, but it changes the character. So if you own a property that you're going to use as a rental property and you use it for less than 14 days a year, then no harm, no foul. It's considered, you still get all the deductions. If you cross that threshold, it starts limiting what you can deduct.
Okay. And what about depreciation? I know that a lot of people who have rental properties count on depreciation to offset their taxes. Is it different for commercial versus residential properties or rental properties?
It is. The time frame is quite different, and a couple different things related to that. So residential real estate is deductible for depreciation over 27 and a half years. Commercial property is 39 years. You also have to figure in the percentage of the value of the property and the amount that's land. You can't depreciate land. So let's say maybe 80% of the property is the building and 20% is the land. You could deduct that 80%.
And what about if I rent out my main home and I live in the little auxiliary dwelling unit on the property? Can you deduct there? Or what about renting out a bedroom through Airbnb or through your whole house through VRBO?
So that's a pretty popular thing to do, is to rent out your whole house. Maybe you travel for work a couple weeks a month and you want to rent your home out while you're gone, or just rent out a bedroom on Airbnb or VRBO. You can certainly do that. However, many rental properties with the depreciation produce a loss that you get to take that offsets other income on your taxes. If it's an Airbnb type situation, a vacation rental, you typically cannot take that loss unless it's used exclusively for that.
Okay. And what are passive losses when it comes to rental property?
So rental property is taxed a little bit differently than other income. It's considered typically a passive activity, and there are losses that you can accumulate over time, but they're limited. So for a regular person, it's typically, depending on your adjusted gross income, limited to $25,000 a year for the loss, and then anything above that would be carried forward. If you're a real estate professional, so you are a realtor, that limitation is not there. So you have some advantages if you own rental property and you're a realtor.
Oh, okay. So that makes a lot of sense. And what about handling the cost of repairs and maintenance and that expense against your taxes? How does that work?
So you do get to deduct that, but there's a couple things to keep in mind. You can deduct up to anything under $2,500. If it's over that, you typically have to capitalize and depreciate that rather than just deduct that. You need to make sure you keep all of your receipts. And if you're paying a subcontractor to do any of those repairs, and you pay them more than $600 a year, you need to issue them a 1099.
Oh my gosh, it's like a real business.
It is like a real business. And I think a lot of people don't realize when they get into the rental property business that it actually is a business.
Okay, I am tired of dealing with renters and damage to the property or I just don't want to worry about it anymore and I want to move on and move to Hawaii or something. What
Sounds
happens?
nice.
Who wouldn't want to move to Hawaii? What happens to my taxes and my tax liability when I sell the rental property?
So there are a few different things that are to be considered. So if you're wanting to maybe just switch from one rental property into another one, you can do something called a 1031 exchange and defer that gain. But if you're just selling it outright, you are going to have some gain, which is the difference between what you purchased the property for, what you put into it additionally, any improvements, and then the current market value that you sell it at. You also have recapture of that depreciation, which is additional gain. All of that depreciation that you deducted along the way, you now have to pay taxes on that as well.
Ouch. You better hope your rental property really appreciates to cover all those expenses. But thank you very much for joining us today. And if you want to know more about the tax implications of owning rental property, contact Michelle Coy at forewarned.com. I'm Deborah Uroda for It's Your Money.